Well, it's a week where the market continues to furiously debate central bank actions or the perception of central bank actions. We've seen equity markets stage a reasonable rebound, the Nasdaq leading the pack up 6% over the last 5 days. We've seen the US dollar breaking out of its December highs, only to roll over and fail at those levels. And we're seeing crude being hotly debated as we go into the OPEC meeting in the session ahead. Prices look firm. We debate all of these factors and more as we go into the trade-off. Hi, I'm Chris Weston, Head of Research here at Pepperstone. I'm going to be joined in a second with Blake Morrow from Forex Analytics. So we're going to be unpacking, we're going to be analysing, navigating all the big landmines, the trends, and the key setups that have caught mine and Blake's imagination that are being hotly debated, not just by ourselves, but also from traders on the floor across asset class as well. So remember, if you like what you hear, do hit the like button. That would be fantastic. And if you want to subscribe, then you'll never miss a show going forward as well. And of course, it goes without saying that anything that Blake or I say shouldn't be considered personal advice. It should be general in nature as well. So let's bring Blake into the program. And Blake, before I wanted to discuss markets, and I hope you're doing really well, mate. I want to just say to everyone out there that we have joined the TradingView. This is a big venture that's been in the works for a while. Obviously we still continue to hold allow clients to trade on CTrader and MetaTrader platforms as well. But now people will be able to go into the communities, into the fantastic charting in TradingView, and be able to execute their transactions or their orders through straight from the charts into TradingView, and that will feed into the Pepperstone back end as well. So this has been sort of debated and wanted from clients for a while, and it's now gone live. So if you want more information, do reach out to the team at Pepperstone. It's a platform that I use for my charting as well. And Blake, as a question to you, I mean, do you obviously use this one? So you bring out the charts every week. This is a platform that you use to execute your orders as well. Yeah,
it is. And I think it's a really, really wonderful, feature that you're giving to all the Pepperstone clients. It's something I've used the TradingView integration and traded through them for quite some time. I've been using their charts with Forex Analytics since we were established like 5 years ago. So I love the TradingView platform. Like I said, I think it's a great tool that all of your clients are going to love to use.
Yeah, cool. I think it's and some of the functionality on there is fantastic. Obviously, if you're still using and you're getting utility out of MT4, MT5, and CTrader, continue to do so. That doesn't need to change. But if you do find that TradingView is a platform that you've used to do your analysis and then go back to MT4 to transact, this is something that can make life a lot more efficient for you going forward. So do check it out. I think you're going to be really pleased with the offering that you're going to be seeing there. So fantastic platform for people to trade on. Now let's go straight into markets, because again, it's been another wild week on markets. Things have calmed down a little bit. We've seen good short covering coming through. I want to bring up the first section there. Let's go into Topical Thunder. Well, Blake, the first one we're going to talk about is I've pulled up the Nasdaq because it really has been the sort of poster child of this kind of snapback rally. We've seen the Nasdaq up 6% over the last 5 days. US equity markets have really worked quite nicely. We've seen European markets also working quite well. Asia's underperformed. I mean, we know we've seen China obviously off for Golden Week and the Lunar New Year, but we've seen Nasdaq really working quite nicely. We've seen those markets moving back up to sort of 38% retracement of the high to low. So the question I'm asking for you, and we asked this last week, has this got more legs? Can we continue to expect this markets to perhaps push a little bit higher into the 50% retracement level? Can market continue going forward, or is this just a bit short covering that's probably done its dash and people will be looking to raise cash levels on any kind of rallies here? What's your view on the equity markets more broadly?
That's, it's a great question. And yeah, the NASDAQ has had a nice recovery. And what's most impressive, I think, about the recovery that we've seen in NASDAQ, it's rallying in the face of yields rising too. And that's kind of impressive in itself. However, I've got more to say about the equity markets as we go through this show. So make sure you guys don't go anywhere, because I do have an opinion. I have a couple of setups that I think you're going to want to take a look at. However, the NASDAQ closed back above the NASDAQ 100 closed back above its 200-day moving average. That's important, and I think we can reclaim the 50% retracement, even the 618 retracement, which is 15,600, which is also the previous neckline of the double top reversal. So I still think there might be a little bit more juice in the tank, but you got to start being careful. We've had a nice rally, as you pointed out, Chris, and I hate chasing the markets. especially in this environment. I do believe that central banks are tightening globally, and I think this is going to be a headwind for markets. It's not, I don't think it's a market where we're going to be looking at all-time highs every single month. We're going to be in more of a range. So I think you got to be careful chasing higher.
Well, I think you're right. I mean, look, the market's above all its short-term moving averages. They're pointing very strongly higher. We're about to see crossing overs of sort of 5-day EMA over the 20-day. It just tells you that momentum's firmly to the upside now. So it doesn't lead to guarantee any kind of future upside. But I think the level that we'd be looking at is the double bottom that we got last year. And I think you're looking around 15,500. That would be the level that I think we can squeeze up to in the short term. I'll be watching how price reacts around those kind of levels. But what we've seen is earnings have come out. Have a look at those numbers we've seen from Alphabet. They were sensational. Apple obviously starting that runoff last week, and those numbers were pretty good, but Alphabet have come out with good numbers there. So we are seeing some of the high beta names coming out. Tesla's looking pretty good at the moment, and Microsoft, fantastic earnings from those. So the mega cap companies, those giants, have been contributing towards this move. So I do think that we probably get a little bit more of a squeeze up. That would be my base case at the moment. But I think 15,500, if we want to use the Nasdaq as our proxy, I think that would be the level that we'd be looking just to see how price reacts and whether a price can roll over. So that's kind of my short-term target in that market there.
And I think that's rightly so. So, I'm going to actually shift gears a little bit, and I want to talk a little bit about non-farm payroll, Chris, because look, we just had the FOMC. We kind of know where their head's at now. And I guess the question that I have I've been asking a lot of people this question, and I'm going to pose it to you. Does NFP even matter? Or actually, I could even take a step back and say, does data from here for the next month and a half or 2 months, does it really matter at this stage? So NFP is always the marquee event at the beginning of each month. First Friday of the month, here we go. We got non-farm payroll on Friday. What are your thoughts here with the jobs data? Is it gonna impact the market, or should we just if we get an aggressive move, we just fade it? What do you think?
I think the first thing you got to do is as a trader is understand, if I've got a dollar yen position or a gold position, do I have any concern with holding it over that news event? That's one of the first thing we do as part of our risk assessment. And for me, no, I don't think. I think obviously, if something really bad happens, then yeah, absolutely, you could see a move. But I think, given so many people are going to be furloughed through January, and they're not going to be counted. If they're not paid, they're not going to be counted as a furlough worker in the household survey, effectively in the non-farm survey, should we say? There could be a situation where we do see a reasonable amount of job losses. But it's going to be because of one-off factors. And the White House has been preparing the market for a weak number there as well. What's more important is the unemployment rate, which is a different survey altogether. So the market's expecting that one to stay at 3.9%. And I think what could really be the bigger issue is what happens with wages after the employee cost index last week was so weak. The market's looking for that to tick up to 5.2%, one of the highest levels we've ever seen. So I think I wouldn't be looking necessarily, I think, at the headline number. I think the market could be quite desensitized to that. I'll be looking at more the unemployment number, which is based on a different calculation, and the wage data. I think if we're going to see a move in the dollar and all the derivatives of that, then I'd be looking at wage data. What do you think?
Yeah, well, I think that's a great point, is looking at wage data, because if the jobs data doesn't really matter, and as you pointed out, we could actually have a negative print. We could, and the White House is preparing the market for that, if you will, for a weak data. But the market does care about inflationary pressures. Sure. So the wage data is going to feed directly into that narrative. Does the Fed really have to, continue to pay attention to these price pressures? And if they continue higher, is that going to keep them in the more hawkish camp? And so, when you talk about the NFP, I think you hit the nail on the head, Chris. You got to watch not just the headline number. You have to watch all the other data that's surrounding the NFP as well.
But I think your point is a really good one. And that is that, are we in this kind of holding pattern now where the market needs like a kind of trend in data to make us understand, can we get more rate hikes that are being priced into the swaps market or the rates market? Or are we going to see them being priced out? And are we going to see a situation where we could see like a stagflationary environment, which we need to, position our portfolio? So we are in this kind of holding pattern where we're getting central bankers telling us what they think about, 4 rate hikes, 5 rate hikes feel good, such as Bullard last night. but I think, the data needs to show a trend, and that could take a couple of months. So I think, I don't think this payrolls number is something that immediately feels like we're going to see a huge move. I think the chances of that are pretty low. And then I go to the next section, which is really around central banks, because what's being priced into markets now is partly for me why equities are rallying. Markets are priced in so much in terms of rate hikes for this year, and I think that's obviously the thing that people are debating. I mean, let's go through them. The next Fed meeting that we've got is on the 16th of March. Well, it might be 15th for you. We've got a 15% chance of a 50 basis point hike at that meeting. It's not going to happen. We've got nearly 5 rate hikes being priced over the 12 months. You go into in Canada, the market's pricing nearly 6 rate hikes this year. New Zealand, 7 rate hikes. We're pricing 2 rate hikes. In Europe, after what we saw there, euros responded to that. In Australia, despite what we saw from the Reserve Bank, they were pricing in 4 rate hikes this year. So the market's gone away and gone, forget about what central banks are saying. We've got our own view about what's going on. I think, can we get further than that? I mean, what do you think here now? Is have we got to the point where we've priced in too much, and the markets are saying that we've hit this kind of peak hawkishness, peak pricing from rates markets?
Well, that's a dangerous game to ask that question, Chris. And the reason why I say that is because everybody was asking that question ahead of the Fed and saying, how can the Fed become more hawkish, or how can we even price in more and the dollar respond to that? And so I think everybody went into the FOMC meeting actually fading the dollar. And as we talked about last week, that wasn't the play. You wanted to be long the dollar. And, now obviously the dollar's faded off those highs, but the fact of the matter is, I think that even though the market is very peak hawkishness for central banks, but how about if inflationary pressures stick around and going to this week, we see wage inflation here in the US maintain or actually, tick higher. Maybe the market says, well, we didn't price in enough. I don't know, but I hear what you're saying. And I think the market is pretty hopped up on hawkishness. But I also have to say equity markets are really, really performing well despite all of that. Right.
The question I think we're probably going to ask then, New Zealand's 7 rate hikes being priced in, Europe 2, Australia 4, just over 4, and you've got in the US 5. The question for me is and also the UK as well. We're going to see a rate hike, coming through in the session ahead. The question I think we need to ask is if any of those jurisdictions where rate hikes come out more aggressively than other places, which is going to lead to that divergence trade and a weaker currency. Which of those jurisdictions do you think is the most vulnerable? Though that rate pricing is going to come out more aggressively. I think it's New Zealand personally. I think 7 rate hikes is punching.
Well, I'm glad you brought that up, and I know we're running out of time, but one of the charts that's not going to be on our screens today or tonight during the show, but should be, is the Euro New Zealand that actually has a big inverted head and shoulder pattern going higher. So that's something to think about too.
Yeah, we saw a bearish outside, engulfing yesterday, and we've seen follow through there. I think Euro Kiwi goes a little bit lower. So despite what I think fundamentally that might play out longer term, I think the flow is starting to sell Euro Kiwi to the downside at the moment. Whether that continues is obviously yet to be seen. So interesting one for sure. Yeah,
it can be, and I think that maybe arbitrage, if you will, between central banks might be a play. But let's talk about crude oil, Chris, because I tried to fade crude oil a couple of weeks ago, unsuccessfully. I took a loss, and it just stayed bid. I thought the technical divergence, and maybe this Russia-Ukraine envoy that we would see this next week is going to relieve some of the pressures. But the fact of the matter is, crude is maintaining gains and it's holding these levels. And I think a lot of people are trying to step in the way of this, very bullish move. So I guess the question would be, do you fade it here? Is it, or, follow price action, which is really bullish. And if it's not going down, it usually only has one other direction to go. Yeah. But do you do that do you do that in the face of everything that's happening, on a more geopolitical scale? What do you think about crude here, Chris?
Yeah, I mean, look, if you trade off a basic momentum strategy, I mean, look, everyone's got their own strategy. Let's say that price is holding the 5-day exponential moving average. So, that's moving higher. It's hugging the upper Bollinger Band. Whatever your strategy, there's some simple rules if you want to say that you don't go short until you see a more destructive picture. For me, this either goes sideways or it goes higher. But for now, I can't take a short position. But what we are seeing is after that explosive move through December into January, the ranges are narrowing quite sharply. People are not prepared to push the price higher. I think a lot of people have hedged crude against this geopolitical risk. If we are going to see a more aggressive invasion, more clear signs of that, NATO stepping up against Russia, obviously financial sanctions against Russia, and then reprisals from Putin. People are hedged. They're hedging themselves through nat gas. They're hedging themselves through Brent and WTI crude, and I think that's in there. And then of course you've got a more impressive supply demand picture, which is pushing and supporting the price from any kind of pullback. So I think everyone's hedged in this situation, and I find it very difficult to be short at the moment until we do see price closing below the 5-day. The ranges start to expand a little bit more, and then I think might see people looking to take profits. But I can't be short at the moment, despite everything. We've got OPEC coming up. We're going to see output increasing by 400,000 barrels. That's fully in the price now. So I think are we in a distribution? I think is that a question that you'd look at?
Yeah, well, I'm kind of focused on what's going to happen on OPEC, here in the next 24 or 48 hours or whatever. But, let's just call it that price is holding up. And while we're above like $83 a barrel on West Texas crude, I don't think you should be on the short side. It has been very, very bullish. But before you take a trade like that, you got to see the whites of their eyes, right, Chris? Yeah. See the whites of their eyes before you take the shot. So that's kind of where we're at. Okay.
We also need higher probability, right? We work in a probability game, and when you're shorting a market, especially something that's on a daily time frame where price is holding up at this moment, you don't have those. You're not skewing the odds in your favor. You're not trying to. So it's about following the flow of capital. And right now, that's not really giving us any high probability outcome. So this is definitely the one that everyone should have on their radar. It's important for equities. It's important for CAD and the petro currencies, and I think risk more broadly. So we've got this one very, very closely on the radar as well. And talking about radars, we're going to go into a bit more structure in terms of the technicals and price action. Let's go into that's the setup. Well, the first one is sterling Aussie. I will say, I am saying this right now just before RBA Governor Philip Lowe speaks. We did see the RBA coming out yesterday, and it was a very neutral statement. The market was looking for it to be more hawkish and open the door for rate hikes. I think rate hikes come in Australia this year, but probably not till November, which is probably just a little bit past consensus. So we're looking from something in the months ahead. But I think rates pricing is rich, as we talked about in the earlier segment. Bank of England, they were meeting in this week as well, and the market's fully pricing in a rate hike there as well. So that can't surprise when they raise rates. It's a question of what do the Bank of England say that suggests they're going to be aggressive in terms of rate hikes throughout the rest of the year. This is why we look forwards and not just at this meeting. But have a look at the structure we're seeing now. We saw price break out of that top Bollinger Band. That was looking really good. The momentum guys out there were sitting there going fantastic. We've seen it breaking out of statistical range, 2 standard deviations. They've obviously been caught wrong-footed. A lot of those people have had to cover. We've come back through the breakout level that you can see, that top black horizontal level. Price has rolled over. We're actually trading through that since I provided the charts now. We're actually sitting at the 20-day moving average, which of course is the middle part of the Bollinger Band there. So it's kind of make or break. We need to push back above that former breakout level. I actually like this one a little bit lower, despite what I think about the Aussie dollar. I think the market is screaming out now. So the question is can we come down to that rising uptrend, which is not a million miles away from the bottom Bollinger Band, and also that horizontal support where I think we'll probably find some buyers through here. But I think there's some downside risk given what we're seeing. Certainly that rising trend can be tested in the short term, and perhaps a break of that level can look to add to short positions in sterling Aussie. What do you think, Blake?
What you don't point out on your chart is if you go out to on August 19th of this last year, we actually tried to break that high, that previous high at 191.50 roughly. We probed above it, came back down. So it's really a false breakout. So I think near-term weakness is possible. However, one of the ways I'm looking at this chart is a big inverted head and shoulder pattern as well. So I'm actually more of a buyer down around 187.50, kind of where that trend line that you have drawn up. Somewhere around there is where I think that we should find some support. And that's going to be a level that I'll be looking at the sterling Aussie. So thanks for bringing that up and bring it to everybody's attention.
Yeah, 187.60 is my would be the level I'll be looking to flip that in any kind of short. So that would be the high conviction level for me.
Well, it's interesting. That's a really, really key level for me too. And so I think if Chris and I are looking at the different charts, same asset, but we're all looking at the same price, that means it's important for you to look at too. Let's take a look at Bitcoin. And I know, I've been bearish on cryptos, since the beginning of the year and really since like December, and cryptos have really fell. And we even talked about Ethereum last week. But what's happened is we've seen risk appetite improve, and we've seen crypto come back to near the 40,000 mark, and it's a big psychological level for Bitcoin. And so that's kind of where I'm looking at. And if we can break back above 40,000, you can see that descending trend line. Back, it was previous support back on, I guess it was September of this last year. We break above 40K and we get a nice solid daily close above that. I think Bitcoin can trade right back up to the 200-day moving average near 48,000, and that's not a small, insignificant move, Chris. That's a big move. Well, so that's something I'm keeping an eye on.
You bring up the word if, and I think that's a big if. And you're looking at Nasdaq. I think you look at Nasdaq. If the Nasdaq's going to continue pushing higher, I think you're probably going to get a higher move up in Bitcoin as well, and the crypto complex more broadly. Bitcoin looks better than the other coins that we offer. Bitcoin and Ethereum have seen this kind of series of higher lows playing through. But if you look elsewhere, you're going to have a look at Doge, Ripple, Dash, these kind of names. They're all moving like pretty much perfectly sideways at the moment. So you've seen those outperformance. So long Bitcoin, short the small altcoins has probably been a good trade in that situation. Now, I think if the Nasdaq's going to roll over at these levels and we see risk coming out, I think Bitcoin's going to be a good short and probably move at a slightly faster pace. And we are pushing those key levels at the moment. So, it is make or break time. But if we do break out of that pattern that you've got there, then that needs to be respected, because it's telling you that the flow of capital is becoming more bullish. And crypto, let's get back to the nuts and bolts of what it is. For me, it's a momentum vehicle and it's a FOMO driver. When I buy it when it's going up. If it's going up, you get the FOMO capital going. I know that sounds really, really simple, and people are like, what? But you can really only buy crypto. Never buy crypto when it's going down. You want to wait for it to go up and hitch a ride as a trader, not as a hodler. So, if it breaks that downtrend, I think that's be very powerful, regardless of what we think about the fundamentals of that situation there. Okay, let's bring up my next trade, which is a little bit more exotic. I've really built my exotic game up today. To be honest,
you really have, Chris.
That's right. Impressed. So my play of the day today is definitely palm trees and desert islands, and it oozes exotic. So look, this one's a little bit more niche. We're talking a relative value play. Exxon. I don't know if you had a look at their numbers, but they're super, super strong, right? Their free cash flow is just blowing out the park. This stock is looking really good. The XLE, which is the energy ETF, the S&P energy ETF. As you can see there, what I've done is I've looked at it at a ratio. So I've got the XLE and I've divided it by the S&P ETF, the SPY. And as this is going up, it's basically telling you that the XLE is outperforming the broader market, right? So you've seen that explosive move up. You've seen that breaking that downtrend. You can see the Bollinger Bands contracting. Bang, up it goes. You can see price holding the short-term moving averages. I love that setup. I just absolutely love it, where the Bollinger Bands contract, the explosion takes place as we break through the downtrend, and it hugs the upper band. What a great setup that is, and it's just been a beautiful trade. The question now is has this got further to go? Now, as we know, the energy sector is looking good. It's a great value play. We've got OPEC coming out tonight, which does concern me a little bit. We've talked about what's going on oil, but I think this continues to go up. Now, it's a mature trend, but I wouldn't be betting against this one at the moment. Any thoughts on this one?
I really don't have a whole lot of thoughts other than you're right. It's a very explosive trend. And I think you've got to respect. Respect is really the key word here. So I wouldn't want to fade it. And if anything, just look for some shallow pullbacks. Whenever you have a strong trend, a shallow pullback of a 38% Fibonacci retracement, those are always like the ones that I'm looking at when I see an explosive move like this. So if you can get that 38% retracement somewhere in that neighborhood between 38% and 50% retracement, something, a backfilling like that, that's the type of pullback I'd be looking forward to take advantage of this very, very bullish trend.
But just to go on, I mean, this is a really interesting way to trade. I know most people are looking at momentum trading or mean reversion, trend following, and obviously choosing a time frame, scalping, day trading, swing and position trading. But relative value, being long one market and short another, and netting off the exposure is a really interesting way to trade. We know that's kind of what the hedge fund industry is kind of based on. So that's a really interesting one there. You're just looking for outperformance of energy and continued outperformance of energy relative to the broader market, so we can go long and short as an ETF. I think that's a really interesting one to play there.
All right, well, let's shift gears over to gold. This is we talked a lot about gold last week. I think that was one of your setups, and I can't argue the reasons why gold should be going higher. It should be going higher, but it's not. But I also wouldn't want to be short gold. And the comment that I made about gold last week to you, Chris, and everybody listening in was, look, longer term, we made this explosive move higher towards 2000. We haven't really pulled back. All we've done is consolidate. But the triangle, this symmetrical triangle, is pretty much perfect to me. And so what that means to me as a trader is I know the levels where it breaks out. It breaks out above 1850. It breaks down below 1775. We're hugging around the 200-day moving average. We're near the middle of this consolidation. But this is the type of setup that we can be literally looking at it today, and by Friday, following the jobs report, we could be 50 gold points higher, 50 gold points lower based on this triangle formation. And I think you've got to take it as a setup and be ready for that move. What do you think here?
Well, I think that it's been going on for a long time, isn't it? I mean, it's like you in the markets, really. It's very mature, and it's you've got this situation. I mean, the longer these patterns take to evolve, the more powerful when they finally actually break out and complete.
Yeah.
And, we don't know which way it's going to go. We don't care. But what we do know is when it does complete, then we need to be prepared to act and react to that. And that's what we do as traders, is we react, right? So if it breaks the downtrend, then short positions are obviously preferred, and that shapes your bias. If it can push back up to the uptrend, or the downtrend, and break through that, then that's going to shape your bias. So we'll say down to the downside, there is really clear support 1784, which we bounced off a couple of times over the last 3 or 4 days, and that needs to hold. And we've pushed into 1800. We pushed into the 20-day moving average there. But I think this is a great setup. We can talk at length about why people hold gold, but right now there's a battle between the bulls and the bears as to what's going on. And when it does break out of this pattern, I think you've got to respect that. That should definitely form your bias going into that situation now. And
that's a setup, right?
That's a setup, mate. That's absolutely right. But it's not one for now. It might take a week or two to evolve. But when it does, I think you are going to see this being heavily debated in social media. When it breaks there, you're going to see it trending very, very clearly. So 100%. Whether you trade it in dollars or you trade it in euro terms or whatever the weakest currency or strongest currency, I think it's an interesting one. Anyway, let's go to our play of the day and see what's on Blake and my mind. Well, I want to bring up the soy meal chart. Now, it's a mature trend. But one of the great things about being a trend follower is you are looking for outlier moves. That's all you're doing. As part of a distribution, you are looking for outlier moves, and you take your losses very, very quickly. You're going to have a lot of losses, but they're going to be very small, and you're going to let those profits run. We can look at trend following and in isolation, but a lot of these agricultural commodities, soft commodities, they come up on CTAs or trend followers radars all the time. They may be a little bit more expensive to trade, but when they trend, there's nothing really out there that trends like these in the market. And what we're seeing in Brazil, what we're seeing in terms of StoneX cutting their forecasts of production, these factors are really boosting a lot of these markets. Go and have a look at oats looking really good at the moment, cattle looking really good, soybeans looking really, really strong. Soy meal has been the one that I've looked at there. It's broken out to new highs. We've broken above the 20-day move, above the top Bollinger Band, which tells you statistically this is a strong move. It's a very positive situation as a trend follower to see price push above that level. I wouldn't be surprised if we saw a little bit of heat coming out in the short term, but I'd be buying pullbacks if not right now. I think this continues higher as a trend following strategy. I think this is one that everyone needs on their radar. I think this one continues trading higher in the short term.
All right. Well, thanks, Chris, for bringing that up. I'm going to put my farmer cap on, and I'm going to be an ag trader too. No, but really, I'm going to actually turn your attention over to the SPOOs because and the S&P. Chris, we talked about it at the beginning of the show. Do we follow these markets higher? And to be honest, I think we've got a nice little setup and a nice little reversal setting up. And I tell you what, there are a lot of traders that are thinking that we're going right back to all-time highs. I am not in that camp. And what I'm seeing is the S&P, you look at these spiders, they sold off on aggressive selling, very high volume. And this bounce that we've seen, volume has been tapering off. Yes, we've seen increased volume because we've seen increased volatility, but volume is actually tapering off on this move higher. I think we are setting up a head and shoulder pattern. I'm actually looking for, when you're looking at the spiders, if you look at around the 618 retracement, which is about 40 or 457, right around that level. And then if you take those previous lows that were set on January 7th, I think that is going to be a nice level, the 450, roughly 457 level. It's going to be a setup for a nice reversal, possible head and shoulder pattern. Remember, central banks are removing liquidity. They're not adding to it. And that's going to weigh on the markets. That's going to be a headwind moving forward.
Yeah, right. And they've not got your back anymore. So yeah, I think that's leaving us vulnerable. So that would, if we do see it breaking through the neckline and goes down, I think that's going to really help out my long XLE, short SPY trade, in that situation. So I think the XLE will outperform. Anyway, that's another week from the trade-off from Blake and myself. We've been talking all the things that are going on, certainly focused on the crude market. We've looked at a couple of pairs trade in the equity market. Blake's pushed out his SPY view and the setup that is there. And it's another week where we're hotly debating the potential for central bank actions and how far down could equity markets fall if they are to fall again before we see that central banks blink and that put coming in. I think it's a long way down from there. But anyway, if you like the program, if you found yourself enjoying the content, if you watched this far, I'm guessing you have, hit the like button and we'll see you next week.